Welcome back. Now, just shy of 29% in December, Nigeria's inflation rate is the highest it's been since mid-1996. That's largely on account of higher food prices and fuel prices. Now, in the meantime, the continent's largest oil refinery has kicked off production in Nigeria. In contrast, a stone throw away from Nigeria is Ghana's inflation rate, which eased in December, falling to 23.2% from a high of 26.4%, suggesting that the climate may be ripe for interest rate cuts this year. The country is also due for an IMF board loan reviewing this Friday. Usoro Essien, who's a stock brokers research analyst at RMB Nigeria, joins us for a closer look at the territories and their inflation trajectories. Usoro, thank you so much for your time today, and hello.
Hi, thank you for having me.
Wonderful. Let's maybe start off by looking at Nigeria. Nigeria has been in what I will call a structural reform journey, and I think there might be still a bit of hangover from what President Bola Tinubu has implemented in the country. Let's talk about that. How are we seeing the FX reforms, the pulling of the fuel subsidy impacting the economy at this point?
Yeah, so like you rightfully said, these reforms have been received very well by both domestic and foreign investors and stakeholders alike. That being said, though, I think the initial vigor of those reforms post the handover in July came with huge expectations. So the appetite by investors, by stakeholders has been wet, and expectations are at all-time highs. So naturally, given the fact that it is more difficult to implement some of these reforms as opposed to actually state them. I think that there is a bit of a pullback in terms of action, especially for new investment interest into the country, given the fact that for the FX, we're still on a price discovery run. The volatility on the official market is extremely wide, and also the natural short-term negative impact of those reforms, which we're seeing in record high inflations.
Let's also touch on the central banks in response. We're speaking about this inflation peaking in December to 28.9% here. Has the central bank responded? Do we expect it to respond to this? And with high interest rates, can people afford high interest rates considering the high cost of food and the high cost of fuel?
Well, for interest rates, again, central bank is actually in a hard place. The new management of the central bank has come into a situation where the key anchoring tool for inflation, the monetary policy rate, over the years before this new management team came into place, had lost its, for lack of better word, efficacy in terms of its pass-through on inflation and a lot of the monetary aggregates, in particular naira aggregates. So the CBN in the most recent action, I would say the inflation just came out, so we've not seen obviously action before that, but in most recent action we've seen use of discretionary cash reserve requirements, so high CRR debits, and this tightens the naira aggregates. It does not have all the required pass-through on rates, because again, it's just trapping and sterilizing funds away from the banks that the CBN maybe would think that the banks could use for FX speculation. But more importantly, they feel that the banks have shown that they're not able to loan out those funds, and as such, the CBN has come up with the need to sterilize those funds by using the CRL. They've also continued their UMO issuances. They did one this year, following the law after some issuances last year. OMO issuances, in our view, have a better correlation in keeping rates high. But in terms of lending to the real sector and the hurdle rate, or the high interest rates, that is expected, given where inflation is. It is difficult to see huge parts of the economy accessing interest rates below inflation, because again the prices have moved, and that is largely due to the shift in the base of PMS.
We are nearly out of time, Usoro. I want to move over to Ghana now and just touch on what they're seeing there. Of course, Ghana's economy also really battled the cedi, also battling quite a bit in 2023. Inflation coming in at 23.2%. Just help us paint a picture of what we're seeing happen there.
Yeah, so Ghana, good progress. Again, you've seen inflation decline even faster than expected by the authorities. We've also seen some resilience in the currency exchange rate. That we've seen stability, very little, I think less than 3% devaluation if you look at it on a month-to-month basis. So we've seen stability on those two fronts. And then finally, we've seen that they've reached an official agreement with creditors for the treatment under the IMF program, and this is largely with foreign lenders of the DFI in nature. We would expect that following this agreement, IMF would now approve this portion of the program, and hopefully the 600 million expected would be disbursed. If that comes in, I think that would bode well for a number of things in Ghana. It would keep resilience for growth. You know that growth did show resilience on its own, beating the estimate or the growth targets of the government by a significant margin, by almost 1.3%. It printed in the last quarter about 2.8%. We are above the target for Ghana's GDP. So with this USD funding coming, expected to come in probably sometime this Q1, we think that will bode well for Ghana. So Ghana is steady on the part of recovery. Hopefully, the recovery should not be retracted by elections coming up towards the end of the year, but that is just probably one concern in terms of their trajectory.
Also, thank you so much for speaking to us today. It's been great hearing from you also about Nigeria and Ghana. That was Usoro Essien. He's a stockbrokers research analyst at RMB Nigeria.